I'm going to have to rush to present basically two papers. One is the work that I did with Romain Rancière that has been cited before today, which deals with the US economy and inequality in the US economy. And then the second, more recent paper that deals with OECD economies and inequality in OECD economies. Here's the usual IMF disclaimer. Yeah, not as important as you might think in this context. So the introduction. We start our paper about the US. We started by looking at the data and noticing a common pattern in the decades preceding 1929 and the 2007 crisis. Namely, what we discovered is there was sharply increasing income inequality measured as the top 5% income share, and at the same time, sharply increasing debt leverage that was not general, but it was concentrated among the lower 95% of the population. The perception that this leverage among that bottom 95% had become unsustainably high was then a key factor that made the financial system more fragile and contributed to causing a large financial and real crash, although the ultimate trigger was not the inequality in itself, it prepared the ground for the crisis. The plan of the paper is to, especially today, very briefly review the literature, then present some stylized facts also very briefly, and then talk about the model that we developed to talk about these things. The literature on the alternative causes of the 2007 crisis typically focuses on has been focusing on the final years preceding the crisis, and has been advancing various explanations like there was too much financial liberalization, there was monetary policy that was too easy, John Taylor, and current account imbalances, Obstfeld and Rogoff, for example. But that's sort of treating this crisis as though it was something that can trace its origins back to things like things that happened only a few years ago. Rajan's book and also our work, we take a different view that many of these things were just a manifestation of an underlying trend that was much more long-term and that was ultimately driven by income inequality. In Rajan's story, it's more of a credit demand story. Basically, the politicians realized that their voters were suffering from stagnating real incomes in the bottom of the income distribution and in the middle too. And instead of doing something about it, they made easy credit available. And that led to much higher credit. So that sort of comes from the credit demand side. Our work, basically in a general equilibrium model, made us realize that this can only be part of the story. And basically growing income inequality in our work simultaneously creates two things. One is an additional demand for credit, that is to sustain the living standards of the low and middle class that lose out in relative terms. And then, but also an additional supply of credit, because when you give additional funds, a bigger share of the pie to the very rich, then that money is looking for a place to go, and it will find a place to go into the financial system and then be lent back to the people who have just lost it in the bargaining game with the top 5%. And that supply channel is actually more important in our work than the demand channel, because especially when shocks are highly persistent or permanent to income, then any model of credit demand would tell you that there isn't much consumption smoothing to be done. You should just reduce your consumption right there and then. But the credit supply story implies that these funds will push into the system regardless, and real interest rates will adjust to make the borrowers take up that credit anyway. Some stylized facts. This is what started it off. The top is the pre-Great Depression decade, and the bottom are the 3 decades prior to the Great Recession. The blue line in each case is the share of the top 5% in the income distribution. It goes up from 24% to 34% in the prior to Great Depression. It goes up from 22% to 34% prior to the Great Recession. Similar magnitudes, actually an even bigger swing up in the more recent period, but over a longer period. The red line, the dashed line, is the private debt to GDP ratio, which roughly doubled prior to the Great Depression, And it also roughly doubled from around 75% to around 140% prior to the Great Recession. The magnitudes are larger in the more recent period, but the relative change, a doubling, is roughly the same between the two periods. Then we broke this down, and this is a key graph in the paper, which basically shows the blue line is the debt-to-income ratio over this period of the bottom 95% and the red line of the top 5%. You see that all of this increase in debt, more than all of it, was due to debt going up in the bottom 95% of the population. And so what I want you to remember is I talked about roughly doubled debt levels. Here is another thing that roughly doubled, and I don't think that's a coincidence. This is the size of the US financial sector during this same period, measured in one case as the private credit to GDP ratio, and in the other case as the GDP share of that sector. GDP share went from about 4 to about 8%, which is an extraordinarily large number in its own right, but it doubled anyway. And the credit to GDP ratio also more than doubled from 90 to 210%. And the connection to our story is, of course, that if the rich have all this extra money that's pushing into the financial system, there's an intermediary that's going to make sure that it arrives at the borrower, and that is the US financial system. And so it's no coincidence that that system grew that much during that period. Then we have a theoretical model that explains the data, where basically we have two household groups. We call them investors and workers. And the economy is subjected to only one shock, a highly persistent decrease in the bargaining power of workers or the low and middle class. The response of workers, I'm skipping one bullet and then I'm going back. The response of workers when they have less income would be partly to lower consumption, but partly to the extent that they have access to borrowing, to borrow. And the thing is that this borrowing, when the shock is very persistent, is going to happen over a very long time period, over decades. And so these flows, period by period by period, build up into a very large debt stock when that period is over. Now, the top income group, what options do they have? They can consume more, but there's only so many Armani suits you can wear in a day. Or they could invest more in factories and machineries, but there's only so many of those that you can profitably construct, especially if the demand that you're relying on to sell your products has just been curtailed by taking money away from the people who are supposed to buy it. So you have a third option, which is to just lend the money back to those who lost. And so you get much higher financial investment, and that is recycling the gains back to the low and middle class. And that, of course, is then something that contributes to higher financial fragility and a higher risk of a financial crisis. It still needs a trigger to come along, but the trigger will be much more powerful in this environment. And so here are some model scenarios that I'm displaying here with a 50-year time horizon. So this is not a typical business cycle model, because I'm emphasizing we're looking at something really long run. We have 50 years on the horizontal axis in each case, and we are assuming that in year 30, there's a draw from a distribution whereby a financial crisis happens in year 30. Now, the bargaining power is on the top left, so it decreases over the first 10 years, Reagan years, Thatcher years, if you want, but you don't need to look at it that way. And then it very gradually recovers. Doesn't even need to, but you know, you can do this simulation where it never really recovers, and you get something that isn't all that different. The real wage then drops persistently, and the return to capital increases. Right? This is basically the shares of the pie are getting reallocated. So those are the returns. In the second row, you have what's happening to investors. Their consumption increases, their physical investment increases, but what increases the most is their loans back to workers. And they build up over a very long time period, and they go up by just under 100%. Not of GDP, this is 100% of itself in this period of about 30 years prior to the crisis. Next, the last row, that's workers. Workers' consumption over the first 10 years drops, then it starts increasing a little bit again because higher capital investment to some extent does support the real wage. So there is some positive effect going on. But most importantly, their leverage increases from about 64% to about 130%. This is roughly the magnitudes that we have observed in the survey of consumer finance data that I showed you earlier. And then we're assuming there is a logistic crisis probability that depends on debt-to-income ratios, and that increases from something negligible in the early 80s to a more substantial, about 2.5%, just prior to the onset of the Great Recession. And then we assume that in that period 30, the crisis actually happens. But what you should notice there, in the crisis, the workers' debt-to-income ratio doesn't decline all that much because two things happen. Debt decreases, but the wage also decreases because the crisis has a lot of real effects that are really detrimental to the real wage. So you're kicking the numerator and the denominator. And so this doesn't really release the pressure on workers in terms of their debt burden that much. And that's why we then talk about we talk about some other scenarios where there is no real crisis, and only a financial crisis, so that's a little bit like debt forgiveness. But you still get in that scenario, after the crisis, after year 30, that debt keeps rising again. And the reason is that the bargaining power in none of these scenarios is assumed to change course. So what we're assuming in this scenario is that bargaining power in year 30 is going to be raised back to what it was originally. And we're not talking about how this is going to happen. This is very difficult, and it's discussed in the paper. But let's just assume it happens. What would that do? Well, that would lead to a recovery in the real wage instantaneously, which would give workers the means to service their debt over time. So they don't need to default on them anymore, and we assume there is no financial crisis here in year 30 because investors can see that they're going to get their money back because workers have more money. The key thing is in the bottom here, what that does is that it takes the debt-to-income ratio on an immediate downward path because workers can now start to deflate that balloon of debt that had been building up before because of greater income inequality. Okay? I may not have a lot of time to talk about how this could be implemented, but it's about wage times the 1 minus the tax rate is what you have to affect to make this happen. So either you can directly strengthen bargaining powers, which has all sorts of drawbacks and difficulties because the jobs might move to other countries. Yes, but if you don't face this problem, it's not costless because this theory will tell you that, well, then you have to put up with these extremely costly financial crises. Which one is more expensive? I don't know, but you should at least make that judgment and not ignore it altogether. And then you could think about taxes. You don't want to switch from labor income taxes to capital income taxes because it's very clear that that would reduce investment and output, but you could switch to rents. You could switch to unearned income, to classical taxation theory that has been almost entirely neglected in the debate. You could switch to taxes on land, natural resources, and rents in the financial system that do not distort incentives, and that may be another way to do it. So summary, we started with an empirical link. Prior to 1929 and 2007, there was higher income inequality, higher leverage, and eventually a large crisis. We built a theoretical model where the key shock was a decrease in the bargaining powers over incomes of workers, resulting in a smaller share of the pie. And the key mechanism is that the investors, when they get a bigger share of the pie, recycle a lot of the gains back to workers by way of interest-bearing loans that build up into this big debt-to-income ratio that makes this financial system more fragile. And then we concluded that it is really only an improvement of workers' bargaining power or taxation that could lead to a sustained reduction in crisis probability. If you leave bargaining power untouched, then you will always get these funds from the investors pushing into the financial system, looking for a place to go, and eventually ending up in higher loans. Is government debt a separate issue? We're all talking about sovereign debt these days. I want to make the point here, it's very important, that this is not really a separate issue. A significant share of government debt, especially in Europe, has just been another indirect way for the lower and middle classes to borrow for various social programs over the years. At the same time, a lot of the resulting debt is held by the top income group. In the US, I'll show you some data in a second. This is, of course, not 100% true. None of this is 100% true, but the tendency is that way. And so, essentially, we're now having the rich who bought the government debt lending to the taxpayer. The taxpayer has to ultimately service this, and the taxpayer was the one who ultimately received the benefits. And it's not that different from the private debts that were incurred for related reasons. Of course, you have to make an exception here. This does not hold to the same extent when the government debt is held by foreigners. Then there's separate considerations. But these are financial asset shares of the top 5% income groups. So this is fixed income, not just government debt. It's the best I could do. Direct bond holdings, their share is 85%. Mutual fund holdings, their share is 65%. Retirement accounts, even, their share is 40%. So they are the major holders to the extent that I could make out. So government debt is not a separate issue. Now, how about foreign debt? This is the new paper with five co-authors. It's called Income Inequality and Current Account Imbalances. So we observe, and I'll show you the plot in a second, empirical regularities for the major economies, namely that more inequality is almost always accompanied by a current account deterioration. We seem to have some disagreement here with the first talk, but we actually did some very thorough empirical work that confirms this finding. The major exception is China and countries like China, and I'll talk about that separately. The explanation in general is that workers borrow from both domestic and foreign investors in the open economy when their income share goes down, because they can now access foreign savings as well as domestic savings. And that means it's a capital account surplus, and that means it's a current account deficit. That's just, by definition, it has to happen. The explanation for China is that the Chinese workers face borrowing constraints, so the Chinese investors don't have the option to the same extent, the option to lend to the Chinese bottom 95%. So what they do, the only financial asset that they can find plenty of in the world is outside China, so they export their capital, and the result is then a capital account deficit and a current account surplus. And Germany is a case in between. I've only started working on that. The financial markets are clearly there, but for some reason the outcome seems to be, could be more closer to China, because for various reasons Germans did not borrow to the same extent in response to greater income inequality as Americans and British. But this is something that I'm still working on, so it's too early to talk about. So here's that plot that I mentioned to you. On the horizontal axis, I have the deterioration of the top 5 income share in percentage points. I mean, deterioration means when it gets bigger. And on the vertical axis, I have the current account to GDP ratio, also in percentage points. And what we observe here is, first of all, almost everybody except Switzerland and Netherlands is to the right of the y-axis, meaning that their income inequality got worse. The other very interesting thing is that there is a negative relationship so strongly when there is an stronger increase in income inequality, there's a worse deterioration in current accounts. And the cluster on the bottom right is the Anglo-Saxon countries. It's the UK, it's the US, and New Zealand. Portugal is one extreme case that's not Anglo-Saxon, but everybody else down there is Anglo-Saxon. Now, this is only correlations. So, of course, we have to do proper empirical work controlling for other determinants of the current account, so we did that. But first I want to report on some scenarios where I repeated the earlier scenarios in an open economy, and we calibrated this to the UK economy, where we again have a persistent large negative shock to workers' bargaining power there at the top left. And now we want to observe what happens, and if you can see it, the green faint line in each case, that's the data for the UK. And we see that this shock matches at the bottom right there, the top income share of the UK pretty closely over the period. The debt also increases, similar to what we saw in the US scenario, but not by as much as in the data. In the UK, the debt-to-income ratio of the bottom 95% increased even more than in the US, I think, a little bit. But for the current account, we're not able to match it 100%. We only get a small current account deterioration from this. We add financial liberalization. There is reasons for thinking that financial liberalization and income inequality are very tightly linked both ways. One link is the Rajan link, is that when you have greater income inequality, politicians feel compelled to allow financial liberalization. The other link is the Philippon link, that when you have financial liberalization, that itself contributes a lot to greater income inequality. But in the model, we model these separately by basically as a shock to an intermediation spread, whereby banks find it much easier to lend. And then the key result is that you have the blue line is now the new scenario. Basically, in this case, workers don't need to drop their consumption immediately because they can borrow a lot. in the first decade. And so that's what we observed in the US and the UK. Despite the fact that there was this increase in income inequality, consumption was actually not dropping, and financial liberalization may have had a lot to do with that. But when you do that, then you get a big kick in the current account. Then you really get this effect that the investors basically borrow and intermediate a lot of funds. And so then what you end up with is a story where a country that allows this increase in income inequality does not just observe a big increase in domestic debt, but also in foreign debt. And this is the case for China, and then comes my conclusion. The case for China, workers' consumption here falls more heavily than in the baseline scenario. The red line is China, the black line is the original scenario, and that's because they can't borrow to smooth this shock when they're hit with it. Then what happens is that the investors have to take their funds and take them elsewhere if they want to do financial investments. They cannot find an outlet in China to the same extent. They take them overseas, capital account deficit, current account surplus. That's exactly what you observe there. We're not claiming that this story of the Chinese current account is all or even most of the explanation for it. All I want to show with this is that it can make a contribution to that explanation, and also that it does not contradict our earlier story for the US and the UK. The empirical results, do I have time to talk a minute?
30 seconds.
We basically do empirical results and control for all sorts of explanatory variables, and we find that a 1 percentage point deterioration in the top 5% income share leads to a short-run deterioration in the current account of 0.1 and a long run of 0.2 percentage points, which means given the observed UK deterioration of about 10 percentage points, you would expect a current account deterioration of about 2 percentage points, which is exactly what you have in the data, at least on average. The current account is very volatile. So we basically find that the scatter plot that we saw earlier survives more rigorous empirical analysis. So this is my last slide. We observed in the open economy the empirical regularity that more inequality is almost always accompanied by current account deteriorations in developed economies, in the subset of developed economies. We saw that China seems like a contradiction, but it is not. The explanation for the developed economies is that workers borrow from both domestic and foreign investors to cope with the deterioration in income inequality, and that's like the Chinese lending to the Americans. And the capital account surplus implies current account deficit. The explanation for China is that the Chinese investors cannot lend domestically and therefore lend abroad, i.e. to Americans. So in some sense, you could say, for China, this story about this story where you say, well, when you give more money to the rich, the marginal propensity to consume will go down, and therefore you get a current account surplus. Here it holds. That holds, but only because they can't lend. When you can lend domestically, that story does not hold to the same extent. When you have these two stories interacting, you actually get these two inequalities feeding each other, because the Chinese setup with their financial markets means that there has to be an export of funds, and the US setup with these highly intermediating financial markets means that it's so easy to have an import of funds, and the two inequalities actually feed each other to lead to higher debt in the deficit country. Thank you.
Thank you very much. Clarifying questions to Michael, if they are, please.
I can just. How do you define this shock to the bargaining power? Is the bargaining power, let's say, an exogenous parameter, and you just change it permanently?
Yeah, technically, what we do is Nash bargaining over the real wage between workers and firms. And in Nash bargaining, you have a Nash bargaining weight, and we shock that weight. There are other ways of doing it that I find less plausible. You could, for example, just shock the technology parameter in the production function, saying that the technological share of capital goes up. But for the US, that seems counterintuitive to me, because I don't think the technological share of capital in the US has gone up. So our story is then not that it is the capital share parameter, but it is some sort of bargaining share parameter in a Nash bargaining game. But actually, just for information, when you do the two things, the technological or the bargaining parameter, the results are not dramatically different. There are some interesting differences, but they're not dramatically different. What matters is that you get income redistributed from one group to the next, and that's what starts off our story. Yeah.
Well, let's not enter into a detailed discussion. Perhaps you can do this after the
I'm here.
during the lunch break. If there's another clarifying question, let's take it and then go for the panel discussion. We have 20 minutes left. Please.
Just a pure clarification question. What dates on that current account thing were you actually counting over? I mean, it just wasn't clear. Is it 20 years, 10 years?
It's starting in the early 80s, 20 years, 20, 30 years is what I was showing.